around 1261.
All right, let's go to Sector Spotlight, where we're going to measure the temperature of 3 ETFs to see what the sectors are doing and what that means for the whole market. Let's start with the semis. It's SMH down more than 2% Friday, hitting a double top. That's pretty negative, isn't it?
Well, it hit a double top of a few prior weeks, and now we're getting the follow through to the downside. Ever since Intel came out, or Goldman came out on Intel with its downgrade and it broke its upper range, this whole group's been under pressure with the NASDAQ. If you look at the SMHs, we've talked about it a few times about getting out of it. Remember, we were talking about it up here, and I said I see a wedge. If it breaks to the downside, you have to get out. You had to break, you had to retest, and we've been just meandering lower, below all the moving averages. I think we get at least a test of these SMHs down to 33.66, but I also think we could get down to the 200-day, just like we saw in the spiders. So I think this 200-day is going to become relevant again over the summer.
And let's go to the retail holdings, which is RTH. Trend looks down, heading towards that 200-day. Same deal, any bright spot? But I'm not even going to bother really asking that question.
Well, again, if they're watching the show, we talked about the ascending channel in the RTHs, meaning if we have an uptrend, but when that breaks, get out of the way. They're only strong until the trend changes. And look how apparent this is here. We talked about this ascending channel that went to the upside. It broke this 112 area. And then look what happened since. That's why you could time these things.
What do you do with retail stocks, though, that have been holding up relatively well, not necessarily from a chart perspective, but from a fundamental perspective, like a Saks, Nordstrom's, Costco, had good earnings, had good same-store sales? What do you do with those kind of names?
Well, you still watch the action. You know, whenever something comes out with good news and it sells off, the market's anticipating something maybe 3 to 6 months down the road. So I know we talked about Macy's. Remember, everything was blockbuster? Let's take a quick look at Macy's and see how the chart, this was your outside day, your upper range breaking to the downside. Remember we said this gap will probably get filled? You know what? It's on its way. So with strong retail stocks, like just say this 26 area, you'll see some of these stronger retailers hold moving averages that are higher. So just say the RTHs get to, you know, the 200-day. Some of these stronger stocks could hold the 50-day or the 100-day. So what you want to see is relative strength. So if the market gropes and holds the 200-day, the stronger stocks will hold the higher moving averages, and that's how you get involved, and that's where you know some leaders can emerge.
Now, I want to hit on the OIH. Held up pretty well on Friday. Now, in my mind, wasn't that a relative positive sign? Because if we're not seeing that slowing demand on oil, even though unemployment in the U.S. is so bad and so poor, that it held up, wasn't that kind of bullish?
Yeah, and it's showing some relative strength, but you're going to need the market to find its bottom or find a pivot low in order for a group like the OIHs to get moving. So if that's the case, like we just said about leadership, if the OIHs don't get to their 200-day and the S&Ps do, that'll give us some signs to go to the OIHs as the market tries to bounce at some point later this year. So if you look here, you know, this is the downtrend that's controlling these OIHs. We talked about selling the upper level on that potent down day, but that's already, you know, hindsight. Now, let's see how it holds this 145. The S&Ps are making new lows. The OIHs aren't. So when we do find that bottom area, the OIHs could be the group to go to, and then we'll isolate the faster moving stocks that could be a lot more exciting than just that ETF.
Let's go to, wrapping it up, the IYT, same deal, watching that 200?
Well, let's take a look. IYT, we talked about how...
fell well below already, right?
Nope, the 200 days down here. We talked about, I remember talking about this area, the support area, saying I don't think it holds up by itself, that, you know, when we're in a corrective type environment, I think cash is king. You don't go to defensive areas, and this broke, and, you know, this could see the 200-day just like everything else. So the bottom line is here, you know, when you're in a corrective type tape, you preserve your cash, okay? You put it in the bank. You don't have to be in something at all times. I like to see the best stocks and the most innovative groups start holding up better, so when the market comes in back into play and we're in a confirmed uptrend, you go with those. You don't just try and find some kind of yield, because chances are you don't need it. Your cash is better.
And what I meant by the 200 days, some of the stocks within the index are already broken their 200 days, so there you go.
Yes, so that just means it's going to go. That means the stocks are weaker than the actual index, so
down.
They're selling it under the hood. And we talk about when, you know, stocks act worse than the indices, then you better look out, because the indices usually catch up.
All right, so that's your strategy for these sectors. We will be right back after your stock picks. Be right back after this for your stock picks.